Hello everyone, welcome to lesson 8 of the Trading Club Q7U course, where we focus on risk first. Today, we're going to cover a crucial topic that will help you protect your trading capital position sizing. Imagine you're at a coffee shop, and you're trying to decide how much of your paycheck to put into the stock market. Do you ever feel like you're tossing a coin when it comes to deciding how much to risk on any given trade? Do you wish there was a system to determine the right amount of your capital to allocate to each trade? Well, that's exactly what position sizing is all about. Position sizing is the process of deciding how much of your trading capital to allocate to each trade. It's not just about how many shares or contracts you buy or sell, but how much of your overall capital is at risk on each trade. By mastering position sizing, you can manage your emotions, minimize losses, and maximize gains. Let's consider a personal example to drive this home. Imagine you're saving up for a new car, and your target amount is 10,000. You have a job that pays 2,000 per month, and you want to invest 20 of your income into the stock market. But instead of investing 400 each month, you decide to put it all into one stock at once. If that stock crashes, you'll lose a huge chunk of your savings, potentially leaving you without enough money for the car. In trading, we use percentages to determine our position size. A common rule of thumb is to allocate no more than 25 of your account value on any one trade. This means, if you have a 10,000 trading account, you wouldn't allocate more than 200 to 500 on any single trade. Here's a real-life example to make this clearer. Let's say you have a 10,000 account, and you decide to buy 100 shares of XYZ stock at 50. Using the 25 rule, you'd calculate your position size as follows. For 20.02x 10,200 for 50.05x 10,500. In this case, you wouldn't buy more than 200,500 shares of XYZ stock. This way, if the stock price drops by 50, you'll only lose 25 of your total capital. To put it into perspective, if you risk 202 of your capital, you could potentially lose 100 with a 50 price drop. But if you risk 5,050 of your capital, you'll lose 2,500. Now, let's talk about common mistakes beginners make when it comes to position sizing. One mistake is risking too much on any one trade, which can lead to significant losses. Imagine losing 10,000 because you risked 50 of your capital on a single trade. Another mistake is not using a fixed percentage for position sizing, which can result in over-leveraging or under-leveraging your trades. To avoid these mistakes, make sure to: first, always use a fixed percentage for position sizing based on your risk tolerance. Second, never risk more than 25 of your account value on any one trade. Third, always prioritize risk management over reward potential. Here's an example of what not to do. Let's say you have a 10,000 account, and you decide to buy 1,000 shares of XYZ stock at 10. This is equivalent to risking 20 of your capital, which is way outside the recommended 25 risk range. For your practical homework exercise, I want you to create a scenario where you allocate 2 and 5 of your account value to a fictional trade. Use a demo chart or paper trading journal, and apply the 25 rule to determine your position size. This exercise will help you internalize the concept and apply it to real-world trading scenarios. Suppose you have a 20,000 trading account, and you decide to buy a stock at 50. Using the 25 rule, you'd calculate your position size as follows. For 20.02x 20,400 for 50.05x 20,000 1,000. In this case, you wouldn't buy more than 4,001,000 shares of that stock. That's all for today's lesson on position sizing. Remember, mastering this skill will help you navigate volatile markets with confidence. Stay disciplined, and you'll see improvement in your trading performance over time. Recap: we discussed position sizing, its importance, and how to implement it on your trades. I want to remind you that trading involves risk, and no one can guarantee profits. Always practice with a demo account or paper trade.